Hi, welcome to Melissa's Money Mindset. Today, we're going to be talking about your journey from no credit to good credit. So this is really important, especially if you're a young adult, maybe you've just moved to this country, or maybe you've never had any kind of debt in your entire life. That's okay. Everybody has to start somewhere. Now, you might be asking, why is having any kind of credit or good credit important? And actually, to just rent a place to live, rent an apartment, or to take out an eventual home loan, auto loan, or even some student loans, you'll need to have good credit to get the best interest rates or to be approved for these types of things at all. So in this video, I'd like to help set you up for financial success and take you from having no credit at all to having good credit. So if that sounds good to you, please do me a huge favor and like this video, subscribe to my channel, and don't forget to hit that notification bell so that you never miss another money-making tip. Let's get right into it. Now, I opened my first credit card in high school, of course, under the guidance of my parents, and I was very lucky because they not only were wonderful life role models, but financial role models as well. And of course, they helped teach me the importance of checking my credit card statements each month, not utilizing too much of my line of credit, and of course, the importance of paying my credit card off each and every month and on time. But today, I wanted to help share some ideas. Whether you're new to the world of adulthood or you're just new to the world of money and finance, I thought it could be helpful to share some ideas that your future self will thank you for and that can help build good credit. So to start with, what is credit? So basically, credit is a prediction of your credit behavior, and it predicts how likely you are basically to pay back any loans that you might take out, and it also predicts how responsible you'll be with your credit in the future. Now, all of this information is reported to 3 different credit bureaus, at least in the United States, which are Experian, Equifax, and TransUnion. Now, these credit bureaus will take all of your credit information about any of your trade lines, which basically are just any lines of credit that you might have, outstanding credit cards, any home loans, auto loans, student loans, any debt that you have at all. And they'll take this information and aggregate it into a credit report. Now, within your credit report, you will see a credit score. Now, you can actually have a few different scores, whether you're talking about a FICO score or a Vantage score. So for the purposes of this video, I'll just keep it pretty general. If you want extra details, I made an entire video dedicated to how to improve your credit score, and I go into much more detail there. So I will link that just up here. But for the purposes of this video, we'll say that your credit score can range anywhere from 300 at the lowest to 850 at the maximum. Now, if you're watching this video, you probably don't have any credit, and that's totally okay. That's where everybody starts out, and that's not a bad place to be. That doesn't mean that you're starting from zero credit, moving to bad credit and good credit. You can move from having no credit at all to having good credit. So your next most logical question is, how is my credit score determined? So let's take a look at this pie chart here where you can see what your credit score is comprised of. So you'll see that the biggest chunk here is made up of payment history. So they'll take a look at if you make your payments on time. Now, if you aren't paying your bills on time, this can very quickly decrease your credit score. So make sure that you're paying attention to this. I highly recommend setting up auto pay if you're new to having any bills at all. The second largest category here is amounts owed. So here they'll take a look at any current unpaid debt. Again, they'll make sure that you're paying these on time. And they'll also take a look at another very important factor here, which is credit utilization. So let's say that you had a $1,000 credit limit on a credit card and you're using all $1,000. You have 100% credit utilization, and that's a bad thing. Generally, people say that the goal is to keep your credit utilization under 30%. I personally recommend under 10%. I believe mine is somewhere between 2 and 5%, depending on the month. And when you're beneath that 10% threshold, that's really when I start to see the most improvement to my own credit score. So other pieces of this pie to look at here are the 10% of your credit that is dedicated to new credit. So this means that the credit bureaus are taking a look at if you're taking out any new credit cards, maybe you applied for a home mortgage, an auto loan, or some new student loans, anything like that will temporarily ding your credit score. Then 15% of your credit score is dedicated to length of credit history. So since I opened my first credit card when I was in high school, I still have that card open today just because that is my longest line of credit. So that's 17 years old now, I believe. And so that's an incredibly useful tool and will help to improve my credit score over time. Now, the final piece of this pie is credit mix, and 10% of your credit score is accounted to credit mix, meaning that these credit bureaus really like to see a mixture of, oh, he or she has 1 or 2 credit cards, maybe they have a home loan or a car loan or student loans. They like to see a mixture of revolving credit, which is your credit cards, and installment debt, which is your mortgage payments, your car payments, anything that you pay the same amount on every single month and you will have paid off over time. So now you might be wondering, what are the steps to building credit if I actually don't have any credit at all? So step 1 is to build credit for beginners. So how do we do that? So the first option is to obtain a secured credit card. So there are traditional unsecured credit cards, basically where you apply for the credit card, you get approval based on your credit history, your credit score, and then they say, yeah, of course, we'll give you this credit card. Your credit limit is $1,000. Now, in the same situation, for a secured credit card, you basically will go to the bank and you'll say, here's $1,000. The bank will take your money and they will give you a card that you can charge $1,000 to. Now, you still have to pay that off. And then after a period of time, typically about 6 months, if you've been making your payments on time and in full, you can then go to the bank and they will often give you your $1,000 back that you deposited, and they can often transition your credit card back to that unsecured and more traditional credit card type. Now, the limits on these secured credit cards are typically much lower. It's just whatever amount of money you want to give them. Maybe it's even $200 or $300. Just enough to cover gas and groceries every month. But again, you have to start somewhere. So this is just a guaranteed way to help build credit in a smart way. Now, no matter what kind of credit card you have, it's really important to make sure that you're paying this credit card off on time each month. If you're late, you'll not only be charged a late fee, which is typically somewhere between $25 and $35, but you'll also be hit with a very high interest payment. So you'll basically be paying interest on whatever balance is remaining on that credit card, in some cases up to 30%. So as long as you're making your payments on time, the interest is completely avoidable, and your on-time payments will be reported even with this secured line of credit to the credit bureaus, and therefore you'll be off to the races in building your very own good credit score. Another tip is to make sure that you're setting any of your lines of credit, your credit cards up for auto payments. Also set any of your bills. Say you have an electric bill or a gas bill, set all of those up for auto payments, because a lot of times people just forget to pay their bill. It's not necessarily that they don't have the funds in their bank account to pay. Life is busy. I totally get that. I myself have been late a few times, and usually companies are more than willing to forgive you. But if you set up auto payment for all of your bills, it takes the human aspect out of it and you having to log in and remember to pay each month. Now, that being said, I still want you logging into all of these accounts to make sure that you know what you'll be paying each month, what you're being charged for. You should be going through all of your credit card statements just to check for, in case somebody stole your credit card, if there are any charges that you don't recognize. You should be going through and budgeting and keeping an eye on all of your finances. Now, like I said, after 6 months, a lot of banks will be willing to trade in your secured credit card for an unsecured or more traditional credit card. Now, this is a lot more likely to happen if you actually bank at that institution. So, for example, I bank at Wells Fargo, and so I have had a checking account and a savings account with Wells Fargo since, again, I was a teenager. So in that situation, they probably would be much more likely to give me an unsecured traditional line of credit because they have direct access to my funds and they can see my transaction history. Now, once you're able to obtain an unsecured credit card, the world is basically your oyster. So I highly recommend taking a look at a bunch of different cards. There are tons of cards that give you credits for travel. They could give you travel points. They can give you cash back. They can even give you double or quadruple points on gas and groceries. So these are all really nice ways that the credit card companies try to reward us for being responsible customers and paying our bills off on time. My second tip for building credit, if you have none, is to become an authorized user on a trusted and financially responsible friend or family member's credit card. Now, basically, you'll be gaining good credit from their credit. So obviously you want it to be somebody that already has a high credit score. Maybe they've had that line of credit or that credit card open for a while. And it's also more beneficial if they have a higher credit limit. Now, of course, make sure that this is somebody that you trust, because now you're basically putting your credit in their hands. So if they don't pay their credit card off on time, that will negatively reflect on your card and vice versa. So if this makes somebody nervous, if you're talking to your parents about this, they could even cut up the credit card that has your name on it. You never even have to use that card. You can simply just benefit from having your name on their account as an authorized user. Now, surprisingly, you can become an authorized user on some accounts as young as 13, but I will pop up a website here with a little bit of additional information about age limits for each credit card company. Now, if you are a teenager or if you have a teenager who's trying to build their credit up, this could actually be perfect. I had something similar to this when I was a teenager, and it was basically my gas card, or if my parents forgot something and they needed me to run into town to the grocery store for dinner, I could just put a few things on this card and then it would be paid off each month. The third idea to build credit, if you have none, is to become a co-signer on student loans or on car loans. So say you're buying your first car, maybe it's $5,000 and you're going to take out a small auto loan on that. Your parents could be the primary, and then you could be a co-signer so that you can build credit that way by knowing that you and your parents will pay down that car together and a payment will always be made on time. Tip number 4 for building credit, if you have none, is to get a cell phone plan. So not all cell phone companies will report to these credit bureaus. So I would make sure that you clarify that. But if you could have a small bill like that even as a teenager or an 18-year-old, you could commit to paying on time, then that could be really helpful, that the credit bureau sees that you are paying on time every month in full, and it can help you build credit. Tip number 5 for building credit, if you have none, is to co-sign on a home or an apartment lease. Now, a lot of people, as soon as they turn 18, they either go to college and they rent out a dorm room, so this wouldn't really work in that situation. But I know that I was living in an apartment, I believe, after my sophomore year of college. And so typically there needs to be a co-signer if you have no credit. At that point, my parents used to co-sign for me for all of my leases before I really had any amount of credit. And so basically the rental company can, if you ask them to, report that you and your parents are paying your rent on time each month, and they'll report that to the credit bureau. Now, I really like to use Zillow Rental Manager for our tenants, and I believe on the tenant side, all you have to do is log into the platform, enable the box that allows Zillow to communicate with the credit bureaus, and you should be off to the races. Now, my 6th idea is to get a credit builder loan. So typically these are not offered through large banks, the big 4 banks in America. But if you go to a credit union, say we have a First National Bank of Omaha in our town, so smaller banks like that or credit unions would be the perfect place to ask about these. They are basically a great way to build credit while you save money. So let's say that you would like to borrow $10,000 to buy a car. So essentially, you would go to the bank, you would say, hey, I would like $10,000 to purchase a car. So they would set up this credit builder loan for you. You would pay into it in monthly installments, just like we had talked about installment debt before. Say you pay $250 a month until you've reached that $10,000 limit. So this account essentially acts as a savings account. And then once you've paid into the account the full amount, the full $10,000, the bank will just write you a check for $10,000, basically giving your money back to you. So in the short term, it's acting as a savings account. In the long term, it's acting as a credit builder by recognizing that you're paying the bank monthly and on time. And by the time you've paid off that $10,000 and received it back in full, you will have built your credit. Now let's talk about other optional loans if you don't have a co-signer. So say you take out student loans. They often don't have to start paying on those student loans until about 6 months out of college. I know that you can also have income-based loans. Now, while you do have about a 6-month grace period once you graduate college, it's also important to note that these loans don't really help your credit at all. They don't really count towards your credit at all until you're in that repayment period. And again, if you don't pay these loans back on time, they can definitely negatively impact your credit score. Another idea is taking out an auto loan and being the primary signer. So we had talked about taking out an auto loan and acting as a co-signer. If you're the primary signer and you don't have any credit, you likely would have to come to the table with a pretty sizable down payment. And you'd also have to show proof that you have a steady job. So you'd have to bring in a W-2 or pay stubs or something like that to prove that you have steady employment. Now, I highly encourage you not to go with whoever the car dealership is recommending. Shop around. I had to do that with my first car, and choose whichever credit union or local bank is the cheapest and gives you the best rates. Nowadays, interest rates for houses and cars are skyrocketing. I have seen interest rates on used cars as high as 15%, but you could potentially get them as low as 6% if you can come with a hefty down payment, show proof of employment, and are financially responsible. Step number 2, once you have built up credit, it's really important that you track your credit score. So there are a number of websites that you can do this on. You can use Credit Karma, Credit Wise, Credit Sesame. I also recommend pulling a credit report. So if you go to annualcreditreport.com, you can actually get a free copy of your credit report. Again, make sure that you're running it for all 3 credit bureaus. This is really important because not all of the same information will show up on all 3 credit bureau reports. Now, I also know that, so I have a credit card through Chase. And when I log into Chase or when I log into Capital One each month, there's often an area on the side where I can click on view my credit score, and it will show me my current credit score. It won't show you for all 3 credit bureaus, but it will show me one credit score, and then it will show me if it's trending up or trending down. Let's say it went up by 5 points this month, maybe it went down 2 points the next month, and it'll also tell me why it moved in that direction. So the point here is basically once you have credit, it's really important to stay on top of your credit score, check your credit report, and check which way your credit is trending. So you might also be wondering, why is it so important to have good credit? So basically, once you're ready to make bigger purchases in life, that's when having really good credit comes into play. So whether you're buying a car or a house, basically the better your credit score is, the better loan terms and the better interest rates you'll be offered. So we can actually head over to NerdWallet, and I want to show you the impact of having good credit versus bad credit. So let's say you want to buy a $500,000 house, and let's say that your credit is in the 620 to 639 tier. You'll see that your interest rate will be closer to 8%, maybe even a little bit higher. So buying that $500,000 house would cost you $3,000 a month. Now, let's change this to have exceptional credit. You can see that your interest rate could be as low as 6%, making your monthly payment on that same $500,000 house as low as $2,400 a month. So basically, you're being rewarded for having good credit and a better relationship with your lender, and you can pay $7,200 less per year to live in that same house. Now, let's just do some math here. So $7,200 times a 30-year term, which is the length of a traditional and typical mortgage, will save you $216,000 over the lifetime of that loan. That's an incredible amount of money and an incredible amount of savings. So I would say that's enough to incentivize you to maintain good credit. I hope that these ideas can steer you in the right direction when going from having no credit at all to having good credit. I feel like this can be incredibly beneficial if you're a parent of a teen, whether you're a young adult yourself, or whether you're new to the world of credit scores in general. Now, as always, I'd love to hear from you, so make sure to comment your credit story down below. As always, feel free to follow me on my social channels right here, and I'll see you in the next one. Bye.